Good afternoon and welcome to our webinar, Raising Capital for Growth, which will be presented by IT Economics' Alan Beaulieu and David Lake of ButcherJoseph. My name is Lindsay and I will be moderating our webinar today. Before we jump in, I have a couple of housekeeping items to go over. Your microphone will automatically be muted throughout today's webinar. We will have some time for questions at the end. To ask a question, simply enter it into the chat box and we'll address them in the last few minutes. Any questions that are not answered during today's webinar will be responded to via a recording. A recording of this presentation and the slides will be emailed to you in the next 48 hours. Now, a little bit about our presenters. With a reputation as an accurate, straightforward economist, Alan Beaulieu has been delivering award-winning workshops and economic analysis seminars in countries across the world to thousands of business owners and executives for the last 30 years. Alan has co-authored with Brian Beaulieu the books Make Your Move, Prosperity in the Age of Decline, and But I Want It. He has also penned numerous articles and makes up to 90 appearances a year. Alan's keynotes and seminars have helped thousands of business owners and executives capitalize on emerging trends. David Lake is a director with ButcherJoseph & Company's investment banking team. During his tenure, David has advised a diverse group of middle market companies on mergers and acquisitions, capital raising, and strategic advisory assignments. He has completed engagements in a variety of industries, including healthcare, business services, manufacturing, real estate, and consumer products. David's previous investment banking experience includes deal work in leveraged finance, as well as sell-side and buy-side M&A advisory. He has advised both publicly listed and privately held companies, including cross-border engagements. David began his investment banking career at Citigroup and its leveraged finance group, focused primarily in the consumer, healthcare, and industrial sectors. David earned a Master of Business Administration and Finance from the UCLA Anderson School of Management and a Bachelor of Science with honors in Phi Beta Kappa from the Haas School of Business at UC Berkeley. He is a CFA charter holder. Thank you all for being here, and without further ado, here are our speakers, Alan and David.
Thank you. David, it's a pleasure to be working with you. I know.
Yeah, likewise.
Yeah, a lot of information to share, and David and I are on the same page with wanting to maximize your takeaway value. So please ask the questions at the end, and as Lindsay said, if we can't get to them, we'll do our best to get you an answer through a recording. I'm going to talk about the economy first, and David's going to talk about investment banking and raising capital for growth and about your future. I'm going to kind of lay the economic landscape for the future, then David's going to dive down into more your business and probably what you need to know, want to know, and not even sure what questions to ask about how to proceed with the transition. Let's first start with this. It's accuracy, accuracy, accuracy here at ITR Economics. If we're not accurate, we're not happy. This is our accuracy for 2021. It's the same list every year. It never changes. And you notice that most of these forecasts go back to 2020. So in some cases, the middle of 2020. Well, things were really uncertain, turmoil, and even the beginning part of this year where a lot of people didn't know if COVID was coming back, states were going to shut down, what on earth was going on. We had to forecast. Our clients depend upon us. So we used our methodology. Same methodology we always use, we just applied it to unknown circumstances, and you can see the accuracy. We're pleased with that. Want to point out one thing, retail sales did not meet our standard. We do not like 90% accuracy. We strive for higher than that. And that's because there was a third stimulus package that the federal government deployed that really boosted retail sales. If they had told us, we could have adjusted, but the reality is we didn't want to just leave it off because of an inconvenience like the stimulus package. Why am I bothering with this? So you have a reason to believe the forecast going forward. If an economist doesn't show you his accuracy, you have to ask yourself why not, and why you should believe anything that they have to say. So with this as a backdrop, and knowing how important it is to us, let's look at the future. What we're looking at here is GDP. It is in deflated dollars. It's real GDP. You can see the teal on the right. We're going to see more growth, but the rate of growth is going to be diminished from what we've been experiencing for the last few quarters. And that's the underlying thesis here for the near term. In 2022, the economy slows in its rate of growth. 23, we see it slows even more. We're going to have a soft landing in through there. Just so you know, the media will freak. The media is going to say all kinds of things like slipping into recession, see what the Fed did, and blah, blah, and on and on. But it's just normal economic business cycle movement. Perfectly understandable. And then see in 24, how exciting it gets. That's where you're going to be busy and having a lot of fun. You should see your revenues grow. If you do this right, your EBITDA will grow. If you have yourself a good time in through there, it's perfectly understandable if you do the right things first. And that's part of where David comes in. And David, as you look at this future, what would you suggest to our attendees here today in terms of this economic outlook? If they came to you and said, knowing this, what should I do? What would you say?
Well, I'd say, I mean, if you're expecting growth like this, it's a good time to invest and certainly take advantage of it. So, if that means raising capital, that's probably a good course of action.
That's what I would think too, because if you invest in your business now while interest rates are low and use banks' money before inflation really begins to kick in, you're going to pay back in a higher inflation period, which means cheaper dollars. And while other people are borrowing money at a higher rate, you'll have gotten in early. I mean, this is like a gift, and it's a perfect time to seek that capital if you have a vision for growth for your company. And some outside capital can be a really positive thing.
Sure.
All right, let's go on. It's about rate of change with us. I know this is boring. You didn't come here for an economics lecture, but it's nice to know how this all works. So we use year-over-year comparisons of 3-month moving totals because monthly data, that's what's in the raw column, can be very volatile and hard to forecast. So you smooth it out a little bit. You do a year-over-year comparison and you get a data point called a 312. 3/12. It's a pressure curve. It's important to seeing the future. Smooth it out some more to a 12-month moving total, do a year-over-year comparison, and you're going to find yourself with a 12/12 rate of change. That's the business cycle pressure curve that most people tend to want to look at and ignore the 312. Please don't ever ignore the 312. It's extremely important. Let me show you why. Let's put this into action. If you are a manufacturer and you depend on capital goods, new orders to drive your plant, or if you're a distributor, if you're just somewhere in this supply chain related to capital goods, look at this chart for just a minute with me, please. Notice that the rates of change are on top. So that top gray line, that's the 312 rate of change. That's a quarter-over-quarter measure. The 12/12 is the top green line. And where those tell you the orders are going to go, they're going to go. It's math. There's no I think, there's no I hope, there's no maybe, especially when you factor in leading indicators, it's a virtual certainty. And that's the accuracy that we strive for, barring unforeseen events, obviously. So the 312 reached the peak, it's downward past the 12/12, gray line has moved below the green line on top. Those are negative checking points. Notice that 12/12 is just about at a peak too. It's rounding the bend, and because the 312 below that, it's certainly going to continue in that path. The leading indicators are signaling it, and that means that the bottom green line where you live, whether manufacturer, distributor, wholesaler, wherever you are in this chain, you're going to see the rate of rise slow. We're at record high levels, but again, the rate of rise is going to slow in 22 and in 23, and that's key because as I'm sure David could talk to you much more eloquently than I can. If you misallocate resources now because you think, hey, we're going to grow by 15% next year or 12% next year, but in reality, you grow by 7.3%, you're in danger. You're going to have too much of some things and not enough of others. And the other thing you might not have enough of is cash. So it's awfully important to us that you allocate accordingly and plan accordingly and look for that growth rate to slow in 22 and then slow some more in 23. And be careful, please, not to outrun your cash. Maybe it's a good time for that infusion as we go forward. Leading indicators, 11 out of 12 are saying the economy is going to slow. You know what? In my world, in 33 years of doing this, we don't often see 11 out of 12 say anything. We're happy when we get 5 telling us the direction. 11 out of 12, they're saying the world is going to slow in its rate of rise. which actually is a good time for you, in my opinion, if you want to invest in yourself, because you won't be as busy. You're going to see your business grow. You're still going to see pressures on you, but a lot of the pressures that are keeping you up at night will become more normal. You're going to find yourself more into a rhythm, and you're going to find yourself able to look in another direction to see what your next steps are. That's one of the nice things about this. You'll be able to look into that next step, have those conversations about, all right, where are we going with this in the years to come? That slowdown is not going to be painful. It's just going to be deceleration. How do I know? Besides leading indicators, there's retail sales. Retail sales in and of themselves are not 2/3 of the economy, but they represent 2/3 of the economy consumption. And the 312 again is below the 1212. 1212 looks like it's reaching a peak. On a deflated basis through January, it has reached a peak. We find that the January number, and you never want to take just one number, but it's indicative of that slowdown we've been talking about. And the leading indicators for retail sales are hard to miss. Are retail sales going to slow down? Yeah, of course they are. When you look at that green line, how could they not, given the historical relationship? Or maybe when we look at the S&P 500 312 rate of change and compare it to the blue line, which is retail sales. Would you want to bet that retail sales are going to continue at the current pace? No, of course not. And if retail sales are going to slow down, then so is a large part of the economy, and maybe your businesses too, if you're B2C. I just did a quick look at a lot of retail sales trends, and we're seeing a lot of them just going through that same process where the 312 is below the 1212, 1212 is approaching a high, the single month numbers begin to show a little weakness, all of which is saying that things are going to slow down, especially if you're B2C, that's important to you. And once more, if you're B2B, this green line is the business confidence index. It tells you where those capital goods new orders are going to go. So that blue line looks like it's reaching a peak. You want to bet that it's not? It might have a little jump left, a little more life left in it, but that green line is saying it's not going to last. And I wouldn't ever want to bet against this kind of leading indicator where you get that kind of confidence in an indicator. And look at the bottom right, please. It leaves the new orders trend by a year, an average of 12 months. Isn't that incredible? You want to see into the future? Find the right leading indicators for your industry and then find them for your business, and you'll know what's going on. And if you're in manufacturing, it's the same thing. Industrial production is 2/3 manufacturing, and the rest is power generation, utilities, and it's mining. And the Purchasing Managers Index from the ISM is saying, yeah, that's going to slow down too. It's all just going to slow down, not break down. So again, you're going to make more money, but you got to be very careful in your process. And if at the same time you want to position your company for sale, then there are some definitive things you're going to want to do, which is what David talks about. You're going to want to wonder what the best timing is, how to structure the best deal, because if 24 is followed by a flat year, that's a different deal construct than if it's another straight up strong year. Hint, 25 is a soft year. If you want to go a little further out, 2026 is a recession. So if you correlate to the economy, and there is going to be a recession in 26, David's going to have a lot to say about how to structure that deal, when you want to get ready, and what kind of terms you want to talk about. So knowing the future here is going to be key to how ButcherJoseph can help you as you position yourself for the next step in your life. And if you're countercyclical, you're going to really like 2026. Depends on where you are in it all. So what are we going to do? Well, we're going to look at leading indicators for the industry, for businesses. We're going to make sure that we budget accordingly as we go into the future. It's as simple as that. Once you know what the future is going to look like, you can just adjust your sails to meet the winds. And if you do that, it's fair sailing. Let's shift gears. Let's talk about the financial world for just a moment. The stock market is the blue line here, and our ITR financial leading indicator is the green line. Did you ever think you'd see a leading indicator for the stock market that looks so pretty? I mean, the rate of change is the business cycle pressure on the stock market. So when that blue line goes up, stock value tends to go up. And when the blue line comes down, there's a slowdown in the rate of rise, or there's a correction, and sometimes there's a crash. But the green line tells you that the tremors we've had in the stock market in January were just part of something larger. That green line leads by 8 months, it's saying there's trouble in the months to come, and you want to be careful about it. In addition to that, the PE ratio is still way out of line with profits, and that bothers us. Doesn't bother everybody, but it bothers us. And at ITR, we have developed something called the ITR optimizer. And the optimizer is a process by which we have leading indicators for the stock market, and we signal when it's time to go into defensive, and when it's time to go into defensive with high inflation, when it's time to get into cyclicals. All the different phases of the business cycle are dealt with in advance so that you can maximize your return. It uses everything that is ITR, and it uses some AI, and it's a process that I think you could really identify with. Most people in business are very methodical thinkers, and it really is just something that makes a lot of sense. Want to know more about that, just send me an email. I don't want to get into it now, and the SEC has a lot to say of what I'm not allowed to get into now. But so sum it up here for you. January woes, some more corrections. You know what, if you're young and you're listening to me, by young I mean a millennial as opposed to a 65-year-old like me, those corrections come, buy into them. When the next crash comes, buy into that one, and you're going to find that you're going to do well, I think, as you go through the rest of this decade. If you're older, that's a different game. Make sure you're not getting out of the market. Don't get scared out of the market. That would be a mistake. You want to make sure you just rotate to a defensive position, which is not cash. It is not a heavy bond position. And then just be careful that you're ready in time for that bear market. You know what's on everybody's mind? Yeah, labor. Everybody's mind. So let's talk about it. Job openings are through the roof, but the most important part is this resignation surge that's been going on. Quit rate in December was a record high. The quit rate in January was very high, although not as high as December. And everybody in every industry that we talk to, I'm sure every industry that you deal with, David. David, have you found an industry where labor is not an issue?
I'm still looking.
Yeah, me too. Me too. And I've dealt with a lot. And interestingly enough, the robotics industry does really well in periods where there's not enough labor, but their constraint is they don't have enough labor to put the robots together and to get them installed. And then clients don't have enough talent to run the robots. It's an interesting position to be in. So we need robots to build robots to train other robots, and that AI isn't there yet. So it's up to us as humans. How do we attract and retain talent? I'm not an HR specialist. I can tell you what works, has worked here at ITR, and I've talked to HR specialists who will affirm this. What works is that you remember three things about the people that you want to hire. Most of them will be millennials, so this is what I'd like you to remember. They want to do well. By that I mean, don't pay them enough, pay them well. Because if you pay them enough, the retention's not there. If you pay them enough, they're going to be happy for a little bit, then they'll walk across the street for the proverbial 50 cents an hour. So make sure you pay them well. And then you have less turnover, which saves you money, and you have gaining some tribal knowledge, which also makes you some money. So make sure you pay well. And then understand millennials in particular want to do good. Do well, do good. And that means they want to make a difference in this world. If your firm has a history of being charity, philanthropic attitude, where you help the homeless, food bank, St. Jude's, Make-A-Wish, whatever it is that drives you, does your team know that? And do they know that by being there, contributing to the company's well-being, they're actually contributing to that well-being of that homeless person that they saw on the way into work? That's what they want. They want to know that they're going to make a difference today. And as you share all the ways that you make a difference, now you've got a culture thing going on. Then you start sharing some numbers and you have a real culture thing going on. And then sharing of numbers leads to the third thing, they want to be involved. Make sure they are involved and share some numbers. If you're not sure what numbers to share, go to Jack Stack's book, The Great Game of Business, go to EOS Traction and look at that book. They're both excellent tomes on how to start sharing numbers. And then as they're involved, they'll start coming to you. And as they're coming to you, listen to them and hear what they have to say and make sure they know they're involved, because they will have great ideas. And that's when you start seeing a tipping point. Is it still hard to hire? Yes. But is it easier to hire? You bet. And then they will tell their friends who will tell their friends the good news about your company. That sounds pretty simple, doesn't it? It's incredible to me how many people are not doing that. They think culture is a myth, too hard to do. We've never done it that way. The list goes on and on. If they don't like it, they don't have to work here. That's a person who's going to be out of business soon. You want to make sure that you're working the culture. Even though the economy is going to help you, you still need to do this. And that's why I went into this first. The economy is going to help you. The quit rate's going to come down. That's the blue line. And when the economy softens, that's the green line, the quit rate comes down. So this intense quit rate pressure that you've been feeling is going to ease, but it's still going to be there. It's just not going to be as bad. So don't forget the previous conversation. And the good news is when the quit rate comes down, that's the green line here, then you see that the labor cost index also comes down. That's the rate of change. So that doesn't mean the cost is coming down, by the way. Not at all. It means that the rate of increase is going to diminish as we go forward. So instead of 7% raises, and if you're thinking, my gosh, I got to do 7% every year going forward because inflation's here and the Fed is this and the news is that and the Wall Street Journal that, forget it. You're going to go back down to lesser increases on an annual basis for 22 and 23, and then inflation's going to start coming back again. But it's not going to be the same pressure that you've had. Life is going to be more like the great before in many respects. So remember, they want to do well, they want to do good, they want to be involved. And when you do that, you're ahead of the game. But don't take anything I've said to make you think the tight labor market's not going to be here for years. It will be. And the firm with the best talent, obviously, is the firm that wins. Let's talk about prices and inflation. Then I'm going to hand it over to David, and then we'll get to your questions after he's done informing us of everything we need to know. Now, at this chart, it looks terrible, doesn't it? I mean, some people just hate this, but I think it's very illustrative and quite beautiful because what it shows us is that all these different price indices essentially move through highs and lows at the same time. I don't need to study 15 different price indices and decide when they're going to reach a high, when they're going to reach a low on a rate of change basis. I know about a rough timing by looking at one. That's copper, Dr. Copper. Dr. Copper will lead most often through highs and through lows, then come steel scrap prices, and then will come the other steel prices and plastics and paperboard and everything else that's important to you. So if I can show you real quickly that we're going to see some easing in business cycle pressure, that's rate of change pressure in copper or steel scrap, then you know that other things are going to follow. And if they follow, that rate of change decline happens, that means that this surge of inflation is going to ease, which is not to say that prices are going to come down. They're not. But you're going to find that the price increases end. And are they going to see more rate of change decline in steel scrap? Sure. How do I know? Well, the global PMI from JP Morgan, 9-month leading indicator, that's a pretty good way to tell. I could look at the China leading indicator. It leads by a year. It's saying that we're going to see an easing. We could look at any number of indicators and just know that things are going to be easing. David, did you want to say something, sir?
Nope, nothing right now.
Okay, I thought I heard you. I didn't want to talk over you. That's all. I want to be sensitive, which is really hard for an economist, by the way. We don't come with sensitivity built in. It's just not there. This is what I meant about prices not coming down. Every diamond's a price point, and so we're just going to see a new normal at an elevated price. Some people are saying, you know, can't wait to get back to 2019 prices. You're probably going to live long enough, but it's going to be a long time from now. We're going back into a systemic inflationary period after 2023, mostly courtesy of labor and the federal government. Good news, I want to share some good news, and that is that there are more goods coming into the United States than ever. Europe is at a 9.5-year high. China is at the highest in 10 years. The world is at the highest in 10 years. It's all good. And the business is of getting goods in and distributed by truck or train and all that, the global supply chain pressure is at its absolute worst, it seems. And I read articles that say it's not going to get better and it's just only going to get worse as we go through the year. And I go, that's utter and complete nonsense. The blue line here is a global supply chain pressure index. The green line is the purchasing managers index. And I'm sure you can see that for all but one instance, The green line informs us as to where the blue line is going. So the Purchasing Managers Index decline is saying that the global supply chain pressure, that blue line, which seems to have reached a high, has in fact reached a high, and that pressure is going to begin to ease as we're going to continue to ease as we go through 22. This one instance in through here, that's COVID. COVID caused that, and then we got past it. This rising trend in through here, that's all demand. We had a supply chain that was overwhelmed by demand. That demand came from two places. People staying at home bought all kinds of computers and desks and all kinds of stuff for their homes. There was just a massive demand pull enabled by all the stimulus checks. And we also found that businesses had a pent up demand when they were shut down for months and then all of a sudden open again. There was this flood of demand. And that flood of demand between the two, B and C, just overwhelmed the system. But it's going to ease, and computer chips are going to flow, and things are going to get back to normal, and life will be better for now. Longer term, we have a different problem. The green line here is the budget. Excuse me, it's not the budget deficit, it's the federal deficit. And when we look at the federal government deficit, as it gets larger, that green line goes down. Scale is on the right. When that happens, history tells us the dollar tends to weaken. So we've gone through some pretty extraordinary times where the world wanted to turn to the dollar and trust the dollar. But when we go back to 23, 24, 25, when things are pretty much normalized, we're going to find that the dollar weakens. And as the dollar weakens, that breeds inflation, which breeds interest rate rise, which is why the Federal Reserve Board is saying, yeah, interest rates are going to go up this year, next year, and the year after. And in the long run, they all agree they're going to be a lot higher than today. You need to plan on that. That's right into David's wheelhouse. Higher interest rates and everything that it means for your business, for valuations, for acting, when you should act and how you want to act. With this roadmap, there's a lot that you can do. That's mostly him. What I want to encourage you to do is to make acquisitions, which is also a ButcherJoseph thing. And so it's a great time to do with these low interest rates with banks with lots of money, but it's also a great time to invest in you. And if you can do it by borrowing, great. If you need to get a larger capital infusion from non-standard sources, do that. But wherever you get it, take advantage of today to prepare for your future. Grow your business today. And you're going to find that as you drive efficiencies in your business ruthlessly, you're going to get ahead of that labor problem. You're going to increase your profitability. And someday when you go to sell the business, it's going to be a very profitable business, and you're going to really like the result. So act on all that, please. Remember, it's disinflation. It's not the end of the world. Make sure that you know how to run a business in a period of inflation. Make sure that you are sure of your competitive advantages, and make sure you are planning for that 25, 26 time period. Slower growth, lots of opportunities, great things coming for you. And with that, I'm happy to turn it over to my friend David. It's all yours, bud.
Perfect. Thanks, Alan. Well, we're going to switch gears a little bit. And once again, my name is David Lake. I'm with an investment bank called ButcherJoseph Co. Hope everybody's having a really nice start of their 2022. You know, we're going to talk here a little about raising debt financing. If you're not familiar with investment banks, we provide a number of different services, of course, and we help folks. If you're a business owner and an executive thinking about selling a business, we'll certainly assist with that. If you're looking conversely at acquiring or bolting on sort of acquisitions, that's something we also advise on. We call that the buy side. And relevant to this discussion, we also go, help folks raise capital, either equity or debt. And the latter is what we're looking to focus on here. So let's jump in. So essentially, the way this discussion will be structured is around kind of three key considerations, right? It's why you want to raise debt, right? We call that the use of proceeds. It's how much are you going to raise? That's the leverage amount. And then it's who are you going to go to and what kind of terms are you going to get? And we kind of use this puzzle piece sort of graphic because they're all sort of interrelated. And you can imagine how you're going to raise debt is a big factor of how much you need, right? You can imagine if you're doing a transformative acquisition, you're buying a company that's 60% or something of your own size, that's going to be a very different capital raise than, if you're opening a line of credit or if you're just, looking to explore sort of equipment financing and such. So we'll come back to these themes as we go through this presentation. But first, I want to kind of just go through a quick recap of the market today, kind of where we're at, and we're going to continue with some data similar to that Alan presented, and just kind of give you a sense for sort of how things are now and how we got to where we are now. So looking at 2021, the good news is, by all accounts, this was a really strong year in the debt markets. And we've got a couple of charts here to walk you through why we think that. So first and foremost, in the upper left, leveraged loan volume, 2021 was, by far a record year since the recession. You can see 615 billion of leveraged loan issuance, far exceeding any other year. And you might be thinking, well, we had a pandemic in 2020. I'm sure a lot of that loan activity was maybe pushed into 2021, and that might be true, but you could see 2020 was a pretty big year in and of itself, just down a little bit from 2019. So good news is, obviously, lenders are very open to providing capital, and that's what's illustrated here. So I guess the second kind of thought is, okay, well, sure, they're lending a lot, but how good are these terms, right? There's quality, or there's quantity, I should say, but what about the quality? So one way to get at that is to examine sort of survey data, and that's what we're showing in the upper right here. And this was a survey done by William Blair of a number of different lenders and such in the market. And they were asked a simple question, which was, was the debt that you've done recently, or the deals that you've done that involved debt, were they lender friendly, in which case they responded with a 1, or were they borrower friendly, in which case they responded with a 5. And you can see, we're up at 4.4, so almost maxing out on the borrower friendly side. So, just a kind of powerful results that, taking these two upper charts together, you've got the quantity and the quality. So it's kind of a win-win. If you're a borrower now, you're getting lots of capital and at really good rates. We'll get to more on that in a minute. Of course, you can't talk about borrowing without getting into the interest rate. And so, lower left, we've got the 10-year Treasury yield, which is kind of a proxy for the typical tenor of a corporate, bond or loan. You can see that we're at, near or below sort of recent median levels. So good interest rate from a risk-free perspective. And of course, the risk-free rate doesn't apply to corporations that have, credit risk, et cetera. You've got to factor in the credit spread, which is what we show in the bottom right. And if you think about it, obviously you're borrowing at, the risk-free rate is meant to sort of capture what the overall level of interest rates are, and then you add to that, in a simplistic way, this sort of measure to capture the risk associated with a corporate borrower. You put those two together, and you got a really compelling rate from a borrower's perspective, because you can see with the credit spreads, there's significant compression in the last year, and that happens when issuers or lenders, they start getting optimistic and aggressive and bullish and whatnot, and they demand less and less interest rate on their money. So again, a good thing, lots of capital and great interest rates. So back to our framework. This is one of the puzzle pieces, why raise debt financing, right? And this kind of just walking through a few of the textbook reasons, just so folks are familiar. But, obviously M&A is a big reason why you'd want to raise debt capital. Certainly you can fund an M&A or an acquisition, M&A event without debt. People do it all the time. You can use cash on hand, you can issue equity, et cetera. But when you have interest rates like this, and a lot of times, with debt readily available, obviously you get typically some deductibility of the interest. It's always nice to consider debt from an M&A perspective. Growth capital, sort of touched on that early on in the discussion, but obviously if you're looking to expand into a new line of business, enter into a JV or what have you, or just buy a piece of equipment, debt capital is a great way to finance that as well. Leverage dividend, again, another sort of reason why you might want to tap the capital markets or the credit markets. And folks may be less familiar with this option. Essentially, almost like a cash out refinance, right? Maybe your company has sort of grown or delevered from a previous debt raise. it might make sense to go out and raise some capital and use that to sort of fund a dividend on your behalf if the company's in the position to do that. And then, of course, there's a number of other reasons why you might tap the debt capital markets, general refinancing, et cetera. Maybe you've got debt coming due. You could have a sort of long-standing relationship with your incumbent bank, and perhaps they're, who knows, maybe it's been a great relationship, but that bank is now sort of moving into different industries or going up or down market, and you want to see sort of what else is out there. It's a great reason to reach out to someone to sort of maybe make some connections to some other folks if you're looking to do kind of a general refinancing. And then kind of included a final catch-all for any other transaction if you're doing a recap or an employee stock ownership plan. Acquisition, another reason to sort of raise debt. So talked a little about why you might want to raise debt. Let's talk a little bit now about that second puzzle piece. How much can you get? And so we put this paradigm up here or a spectrum of sort of what are the factors that influence how much debt you can get. And some of this is sort of might be familiar if you've chatted with a valuation advisor, or somebody has come in and sort of valued your business for you. They'll talk through sort of some characteristics that might determine whether or not you get a high valuation. Or a lot of times that's quoted in a multiple of cash flow or a multiple of EBITDA, and it's very similar with lending, right? So a lot of the same factors that factor into evaluation are critical in terms of how comfortable a bank or a lender can get with providing you with capital. And there's some things that aren't applicable, of course, too. They're less focused on the upside. So things like reliable revenue and profitability, you can see on the right side, that's going to get you more leverage. If you've got customer or industry supplier diversification, that helps too. Obviously, they want to see that you've got a number of customers in different areas, or you got spread out amongst broad range of customers versus select few. And of course, this is more art than science, and everything is taken together, of course. And if you think you've got a number of the items on the left, a lot of times there's mitigating factors to talk through, and plenty of options for debt for you. The other thing I'd say is obviously with size, the larger you are, typically the more options you get in terms of the amount that you can raise, et cetera. And then high asset quality, et cetera, is another factor as well. Then there's a number of other things that are sort of less within your control. And you can see the top part of the page is meant to be internal characteristics and the bottom is external. Things like COVID, we'll talk about a little bit more. Surprisingly, it hasn't had a big impact, certainly of late, on your borrowing options, but we'll go through some other survey data there. So again, just kind of a nice framework to think about, kind of how much you can raise. And obviously, the more of the characteristics you have on the right, the better. But all is not lost if you think you've got a few characteristics on the left. There's lots of ways to get flexible, et cetera, and get debt capital. So just to illustrate this point, you could see, particularly with size, so this is just some real-time data. You can see this is January 2022, December last month, and then a year ago, January 2021. And you can see that, again, this is quoted as a multiple of EBITDA in terms of how much debt a company can get. And as you can see, as you move to the right, companies are getting larger. On the left side, it's under 5 million of EBITDA. In the middle, it's above 10, and then above 20 on the far right. And as you move across to the right, you can see that the amount of debt that's provided, both in both sections, both from a senior debt perspective, and that's kind of the most secure debt, and also from a total debt perspective, which includes things like subordinated debt and junior debt, et cetera. As you move to the right, you can get more and more debt as a multiple of EBITDA, which is a good thing. And again, size is not the only thing that's a factor here, but that tends to play a role in sort of how much you can get from a leverage perspective. So back to COVID. I mentioned that it was kind of surprising, the data. So again, this is from another lender poll. I thought this was kind of interesting to share this time of year, or at this time in the pandemic cycle. But so lenders were asked, assuming your firm's pre-COVID rating was a 5, how would you rate the aggressiveness of your firm's approach to new debt opportunities today? And surprisingly, I'm looking at the top chart here, you could see all respondents came back with values that were above 5 or 5 and above, right? So nobody said they were less aggressive to pre-COVID, which is pretty surprising. And speaks to, of course, all this plays into the data we saw on the first pages about how much sort of lending they've been doing in 2021, et cetera. And then the bottom is a similar sort of respondent data that says, compared to your firm's pre-COVID hold sizes, what have you observed? Has it gone up or remained the same, decrease? You could see most banks have opted to increase their hold size or remain the same. So again, just more sort of real-time data that suggests that despite everything, if COVID is not a sort of negating factor in terms of the quality of the credit options that are available today. So just interesting information there. And then we went and, and this survey went a little deeper in terms of the industry, and you could see that, no surprise, certain industries are more in favor with lenders than others. IT, obviously we saw a big tech boom in 2021, healthcare, professional services, distribution. And part of this is sort of function of the steadiness of the revenue. And again, this chart is sort of, I had to break it up, but the top sort of industries are on the left and it works its way down to the bottom on the far right. And you can see building products, construction, retail, restaurant, energy are the industries that are in less favor. And part of that is, again, not so much that they are bearish on the industries, but that it, there might be factors like lumpiness of revenue or such. And again, all is not lost if you operate in these businesses or in these industries. It just, there might be slightly fewer options. And again, we can get creative depending on sort of the specifics of, the facts and circumstances of your situation. So let's talk now about kind of that final puzzle piece, which is the lender type. And up till now, I've kind of used, kind of a generic definition of a lender, like a bank, right? And some of this folks might be familiar with, but in reality, there's sort of two, and this is very simplistically sort of set up here, but there are two kind of primary categories of players in the lending market. You've got your traditional banks, which I think most people are familiar with, and you also have a second entity called credit funds, or private debt, private credit providers, or direct lenders, et cetera. There's a number of different terms that are used, but it's good to know that there are these different providers out there because they operate somewhat differently, and we'll kind of walk through some of the differences there. And part of the reason is, traditional banks tend to have they're fairly regulated, right, in terms of how much they can lend and what their hold sizes can be and whatnot. And in some ways, they operate fairly conservatively, and it tends to be very cheap capital, which is the great part. But there's less flexibility there. So I wanted to kind of walk through kind of the key differences between these two kind of primary sort of lender groups, right? So, in terms of the amount of debt you can get, right? So traditionally, banks tend to have, as I mentioned, kind of caps or maximums that they can borrow. So generally speaking, you'll get more credit or more debt from a credit fund. Again, there's a lot of variation here. So that's, I put the advantage with the credit fund in terms of the amount there. Interest, I mentioned, traditional bank will be low interest. One of the key advantages with a credit fund is, you might pay a little bit more interest, right? But they can be creative in the way they structure it, that the amortization can be significantly lower, right? So instead of paying, 15 to 20% amort, you could be paying 1 to 5% amortization. So if you factor in, the all-in debt cost, right, with the interest and the amortization, you could have a lower sort of annual debt cost than would be the case with a bank, right? So again, and jumping to the punchline, spoiler alert, the result is that there's no right or wrong answer here. you'll see that if I set this up right, that there's an equal number of advantages for the fund and the bank, and then a draw at the end. But the point being that there are a lot of options out there, and if you've sort of mostly been focused on the traditional bank side, just know that there are some other folks out there that could lend more debt at more flexible terms. And again, we're not steering folks one way or the other, just letting them know that there are people, there are players in the industry that are very willing participants. They wear a slightly different costume, but but good to know about nonetheless. And obviously, at firms like ours, we cultivate these relationships with folks on both sides of the world or the sphere, and obviously don't have a dog in the hunt, and we're not biased, and we just want to see what makes the most sense for our clients. So again, we just have kind of a graphic here. In the end, I mean, the sort of summary really is, you've got to consider economic terms, right? The financing amount, the interest rate, and the fees. And also, structural considerations can be equally as important, right? So the amortization that we talked about, the flexibility, covenants, which we haven't touched on thus far, but, you can imagine that, if you've got a heavy debt service to cover, a lot of times the covenants could be more restrictive, and obviously, the more senior the capital is, typically the covenant in terms of sort of how much leverage you can get, or the minimum coverage ratio, those are going to be more restrictive in some cases, if you're getting cheaper capital. So again, something to think about. And then we just have some pricing data here too. You could see that, as you get larger, you tend to get more favorable pricing. Again, that's not the only factor at play there, but also just to point out that obviously, as the capital becomes more junior, unitranche and then into sub-debt pricing, the debt is increasingly expensive as well, just to compensate for the risk. So again, there's lots of ways to sort of provide debt, and lots of different flavors of it. And it just kind of depends on sort of, what's most important to your situation. And that's what the advisor helps to sort of determine. So thinking about all those different options, I mean, obviously, an important part of raising debt, because there is obviously increased risk associated with leveraging a company, it's critical to go through and do some sort of pro forma modeling exercise to sort of test out, what this leverage would look like on your business. So this is something that, bankers do all the time, and, CFOs do it as well, but it's just important to illustrate that, you'll want to, kind of look at, obviously a lot of companies don't produce a 5-year forecast, but sometimes it's helpful to work with an advisor to do that, to take it beyond, 1 year, 2 years out, build a forecast of the cash flows, and then you can layer on, oh, well, I'm looking at raising 2 times my cash flow, or whatever the case, or 2 times EBITDA and senior debt. What could that look like? Or maybe I'll add a tranche of mezzanine. Again, we didn't really touch on a lot of these topics, but point being that, when you do this modeling exercise, you can get a good feel, at least get some comfort that this debt that you're raising can be serviced by your future cash flows. And these models are set up and to capture, to make sure, you look at the things that we talked about a minute ago, like, the covenants, you want to make sure those coverage ratios are in compliance with what you think might be sort of asked for. Same goes for the coverage ratios. And you can see that's the gray bars we have in the middle there. From a coverage perspective, you want to see those kind of increasing over time, and from leverage to sort of decrease over time. And again, lots of detail here. I know this is sort of small print, but the point being is, you want to get comfortable with the debt that's being raised, subject to what you think your business is going to do. And of course, no forecast is perfect. So there's scenario testing where you can, downside scenario test it to get comfortable with, if you have a hiccup in your revenue or earnings or whatever the case may be, that you have no problem servicing the debt. So, that's kind of the best practices on the front end when you're thinking about raising debt. Obviously, when you're talking about raising substantial amounts of capital, it's not an overnight process. Unfortunately, it tends to take some time, and there's some key steps here. I won't go through all of them, but you know, typically this is what happens if you engage an investment banker or somebody to consult on a debt raise. You know, they're going to want to spend some time learning about your business. That's the due diligence and modeling that we just talked about. That could take a couple weeks. And then ideally it's, typically you don't want to talk to just a handful of folks. You're going to want to see the whole market. Going back to the previous slide about, you want to talk to folks that are traditional banks and credit funds, and market to those folks. And the best way to do that is to come up with a list of parties that are most relevant to your business and to the raise. And that's part of what's going on in the marketing phase. And of course, we're also building out what's called a bank book or an information memorandum that sort of walks through what the sort of highlights of your business are, et cetera. And then there's a whole number of steps that I'll kind of quickly go through, but there's obviously some Q&A and diligence, and can't forget about negotiation. Obviously, the first kind of term sheet that you get from a lender or a bank, there's going to be some flexibility there. It's a good idea to negotiate or have an advisor negotiate on your behalf to get the best possible terms. And of course, lots of documentation and such to go through. And you want to have a kind of a good team watching over you during that process. So the finally key takeaways, as Alan has said, and what we've gone through here, we're in this low interest rate environment, but of course the series of rates are expected through 2022. So we're kind of in this hybrid phase and that's what this graphic is supposed to represent. We've had a long history of a dovish Fed, and we're moving into a more of a hawkish regime, but there's still lots of capital available, and you can see that the debt terms have been really favorable. So eventually that will flip, but right now still getting really favorable terms and good rates, et cetera. Debt universe is robust. It's not just the traditional banks. There's lots of credit funds that are popping up every day, essentially. And you're going to want to have somebody that can kind of figure out, we've cut through all the noise and figure out who are the best sort of investors for your particular business. And of course, you're going to want to do the modeling. You're going to want to make sure you're reaching out to the right folks. You're going to want to make sure that your business is properly marketed, et cetera, and forecasted. So that's obviously a critical part of any sort of capital raise. And I think that's it.
Great, thank you, Alan and David. We do have a couple minutes, and I just saw a question come in here, so we can go ahead and get started there. How does banks view a business looking at debt financing if they already have an EIDL or SBA 7A loan? Question is specifically for IT software industry.
I guess, yeah, I'll take that. It's a good question. I think it's one of those where we'd have to look at the specifics, or you'd have to contemplate what are the terms of your existing debt. But a lot of times that could be refinanced. We would just consider that as part of the whatever new financing you're getting. Some of that would go towards paying down the existing debt. Look to see what the terms are, et cetera. But it's something that that could be worked through.
All right, great. No other questions at the moment, but we do have a couple more minutes, so please feel free to enter them into the chat box. Alan and David, if you guys have any, closing remarks as well, you can certainly kind of get started with those if you wish.
I'll go first, David, and then I'll hand off to you as we hit the finish line, if you don't mind.
Sure.
I like what you said about needing that solid company forecast, and that's one of the things that you and I work on together, to make sure that there's this accurate view of the future for the company, for the industry, because that answers a lot of questions for whatever the lending source is. And as in my experiences, it's those missed forecasts or the inaccuracy of those forecasts going forward, the projected EBITDAs and what the industry is going to do in straight line forecasting. That's where people get into a lot of trouble. And the accuracy of the work you do and the accuracy of those forecasts can really prevent a lot of headaches as people go into the future.
Oh, for sure. Yeah, I mean, it's a piece of the analysis that we spend a lot of time on. We want to make sure that we can get a forecast that folks agree to, multiple folks within the organization, and then we'll flex it, right? You know, if something's, you know, if you want to look, if you know, whatever's happening in the business, you know, maybe a year or two down the line, we'll factor that into, you know, a revised forecast or a plan B or whatever the case may be. But certainly want to make sure that you're starting on a good base of information. But of course, you're just layering on a bunch of other new and, you know, new data and figures, and you know, it's not going to be a productive exercise if you're not starting with a good base of forecasts and projections, for sure.
Oh, certainly not. And if I may, one of the things I really liked about ButcherJoseph when we first started talking was how successful you folks are. I was talking early on and in our discussions between the two companies, and that's impressive to a company like us who's all about accuracy, and your ability to bring things to a successful conclusion is very strong. And it's a broad-based. You brought that out today. You showed, you know, companies of different sizes, and inherent to that is a company of different qualities. And you're not so focused that, like some are, that you're only in this narrow space. And if you don't fit that, go away. You guys have a great success record across a broad spectrum of businesses and industries.
Yeah, we say we're industry agnostic. I mean, there's a few industries that require sort of specialized knowledge that are kind of harder to work with, if you will, for a lot of folks. But you're absolutely right. I mean, it's critical that, you know, because this is a long process and there's a lot of unknowns and a lot of things can happen along the way if you're talking about a, you know, 2 or 3 or 4 month process. So the ability to kind of predict what the market results or what the, you know, what kind of debt capital might be received on the front end, right? And understanding that and working through that with the client goes a long way to having kind of a productive process along, you know, further down the line, right? You don't want to be surprised if you're telling them, well, I think you can raise $50 million at these terms, you know, et cetera, and then you go to market and, you know, it's a lot different than what you expected. First of all your models are off, right? And there's a lot of, you just have to sort of work through a different set of reality than what you thought. And it just, you know, it obviously adds an extra layer of complexity if you miss the prediction on the front end. So much easier to close a deal if you've got a good sense for where you're going to end at the beginning.
Yeah, absolutely. If I remember right too, correct me if I'm wrong, you have a unique preliminary process. I remember that also from our discussions. We have a preliminary analysis before we do any company forecasting or anything like that. It's got to meet certain parameters, and that really helps us know what questions to ask and which direction we need to go and how broad things need to be. You have something very similar, if I remember, and it's not found in every house.
Yeah, we do. We call it a feasibility analysis. And essentially what we'll do is, in the case of like a debt raise like this, is, you know, we'll have a preliminary discussion with a client, understand what their goals are. Of course, we're not going to be doing this in a black box. So, you know, just after a phone call or two, we can get that feeling and get some, you know, some financials, historical financials, and whatever forecasts are available. And then just on the basis of, you know, like I said, a phone call and a few pieces of information, we can put together what we think would be sort of a first cut. Obviously, we're still learning, and there's, you know, we haven't been hired at this point, obviously, and haven't gone through a full diligence, but we could put together a kind of a preview of what a transaction could look like, even, you know, in the first sort of, you know, a couple of weeks of meeting and starting to discuss with somebody prior to being hired. So it's a great way to set, somebody can get, and this is all complimentary, of course, so they can get a free look as to sort of what what a transaction could look like, ask all the questions. We'll show all the minutia and how it looks against, our preliminary models, et cetera. So they can get a good feel that, oh, well, that's what I have. They can confirm, is this what I have in mind? Maybe we'll take it in a different direction. Maybe we'll show them 2 scenarios, et cetera. And it just sort of, the conversation evolves and, from there.
Exactly.
Yeah.
All right. Well, thank you both. We have come to the end of our hour here. So from all of us here at IT Economics and ButcherJoseph, we thank you and hope you have a wonderful day.
Thank you, everyone.
Thank you.